Goal setting is important because our financial ship, it needs a destination. Otherwise, you're wandering aimlessly and you can make poor decisions about money. Now, where you put your money in terms of savings or investments, it depends on when you need it. Money depends on timing. You could be putting it in savings accounts or investment accounts when you invest it, let's say, in stocks or bonds. But first, you need to write your goals. And you can and you should take a break for just 5 minutes right now. Pause the video, grab a phone, a pen, paper, spreadsheet, an app, whatever you like. Write down your goals, every goal you have for yourself. Give yourself permission to dream. You will never surpass your highest goals, so set them high. If you want $10,000, don't put down $1,000. If you truly want 1 million, don't write down 100,000. It could be that you want to travel to Greece this year, like me. Maybe you want to start a business next year, like I want with another business. Or to buy foreign rental units for the year after, like I do. Whatever it is, don't matter what people say. Do not let the naysayers intervene. And don't let anything deter you. When you were a child, you dreamed. So bring out your inner child. We overestimate what we can do in 1 year, but we underestimate what we can do in a decade or even a few years. So just pause the video while you're writing these things down. Now, by the way, the next thing to do is right next to each goal, write down a rough idea of when you want to achieve it by. Be clear. Be detailed. Goals must have timelines. Goals without timelines are just not real. They're just wishes, right? They need to be made real. Make them real. I want such and such by such and such a time. I want X by time Y. It sounds like a small step, but it's incredibly important because the when of your goal changes the how of how you should manage your money. Now, the timeline matters so much because the longer the time frame, the more powerful your money becomes. So for instance, a 20-year goal, at 20 years from now, my goal is to retire. Or maybe send your children or future children, I don't have kids right now, but send your future children to college. This could be a long-term goal. And so with this, you've one of the most powerful forces on your side, time. So backed by over a century and a half of financial history, the Standard & Poor S&P 500s, that's the top 500 companies by market size, over the past 150 years, so looking at data from 1871 to today, 2025 monthly, anyone who held their money for a minimum of 16 years, just 16, never lost their money. At 32 years, it was at least a 4% return. Pretty good, always. Now, even if we go back to that 16 year where you never lose your money, in that particular case, almost 95%, 94.4% to be accurate, 94.4% of the time, your returns were at least 4%. The worst, you might have guessed it, was the Great Depression, that stock market crash of 1929, right, and then the early 30s. And if you think about holding it for a lower period of time, like something like a 10-year hold, 97%, in fact, over 97% of the time, you would not lose money. And 87%, a little bit higher, you would actually get at least 4%. The worst time was the Great Depression. Also, there was the thing called the dot-com era in the late 2000s, early 2000s, right? The late 90s, early 2000s, around that time, 2000, 2001. If you bought it around the height, just before the dot-com crash, the internet bubble crashed, and you sold at the low just after the next recession, the Great Recession, otherwise known as the Global Financial Crisis 08-09. So if you bought around 2000 or 99 and you sold around 2009, 2010, then yeah, you're in a little bit of mess at that point. But it's only that time. Now, at a 5-year hold, okay, if you held it just for 5 years, this starts to change a little bit now. At 5 years, almost 90% of the time, you're positive, or not negative anyway. And almost 3/4 of the time, you're getting at least 4% returns. Now, this is, The worst times, if you're looking at 5-year intervals, well, they go right back to the start when the market was really wild in like 1871. Right, also 1887, 1890 kind of time. There's also the 1902, 1907. 1907, there was a great crash, and that led to the creation of the Federal Reserve. So that was a big crash time. World War I, the Great Depression, World War II, around Nixon's era, the dot-com bubble, as well as the Great Recession, global financial crisis. Now, if you only hold it for just 1 year, then yeah, it's not quite tossing a coin like some people say. That actually 72.57% of the time you would not lose money. So you're much more likely not to lose money. And 65.64% of the time, that's almost 2/3, you're going to be getting at least 4%. It's wild on a given year. You could lose a lot, you could make a lot, but the odds are still somewhat in your favor. But definitely it is, I agree, it's very unpredictable. 1 to 5 years, usually positive, not guaranteed. 5 to 10 years, if you're holding it for 5 to 10 years, mostly positive. 12 to 20 years, honestly, historically, it has never been negative as long as you hold it at least 16 years. 20 years, if you're holding it like absolutely always. Even 12 years since 1972, it's been positive. So the longer you go out, the more likely it is you get positive returns. But even at 5 years, you've got, 50% of a chance of getting 10% returns. Isn't that crazy? And you've got 3/4 of a chance of getting at least 4%. And 90% of the time, you won't lose. Now let's look at a 30-year holding period and assume that we invest $100,000 initially. The 4% return will turn $100,000 into $324,000, or 3.2 times the principal. If you can double your return, get the stock market average around 8%, that jumps it up to $1,006,000, or basically a 10.1 tenfold increase. Now, if you've got 10% returns, this is going to turn it into $1.745 million, or a 17.4x return. So look, value your money. Make your money work hard for you, and let it do what it's historically done to get you to your goals faster. What if your goal is 5 years? So you don't have 30 years to save and invest. Example could be moving to a bigger place or starting your own business. So looking at returns over any 5-year period, as we've seen, the data still holds 90% of 5-year periods, the market delivered positive returns. And over 50% of cases, double digits. There were exceptions, such as if you bought 2004, you sold after the crash in 2009, that was the global financial crisis, there you'd lose about 3% per year. The returns over any 1-year period paint a completely different story. Unpredictable returns, and you just don't know what it would be in 1 year. You could make a lot, like a fortune, or you could lose a lot. You just don't know. For 1 year, although 73% or almost 3/4 of the time you make money, you could lose a lot in 1 year. In fact, you would have lost more than half during the worst year in the 1930s Great Depression. That's like more than 50% wipeout. So if you have a short-term goal of 1 to 2 years, the market is probably not the right place for your money. What I feel if you have, let's say, 1 year, usually you want to hold that in something like a high-yield savings account. More than one, like 2 years, 3 years, 4 years, even 5 years, think about something like bonds, something like the VBTLX. If it's something that's longer than 5 years, that's where you want to think about the index fund, something like the VTSAX stock market. And this circles back to why a clear timeline matters, because once you know when you want something to happen, you can pick the right strategy for that goal. Short term, so like 0 to 1, maybe even 2 years, think about your emergency funds. You're thinking about goals like going on holidays, holiday gifts, putting down a house deposit. making sure it's safe. You want to make sure that it's accessible. So probably not stocks, they're not that safe. Medium term though, like 1 or 2 years, all the way to 5 years, maybe you're thinking of getting a bigger home. Maybe it's some school fees for children a few years from now. Maybe it's that you want to start a big business in a while. Maybe there's just these one-day dreams, right? They're not way out in the horizon, but you're not like the next year or two necessarily. So you want to have a situation there now where money should work harder, because the chance of you riding out the ups and downs of the market and beating inflation even, just protecting your money's future value, that improves massively. So for instance, you could keep the money there in investment accounts that are matching your country's tax rules, as well as keeping in mind to go along with your own individual personal comfort with risk. We'll cover that in a coming section. Long term though, like when you're thinking, 5 more years, at least 5 years, you're thinking like retirement, like true wealth building, future freedom. Give money time and space to grow. Seriously. You want to be investing there. You must be investing at that point, or else you're leaving a lot of money on the table.